In progress. Good afternoon. Hi. Why we only have 11 students here? Is that because Super Bowl last night? Okay. Let me share the screen first. This week we're gonna continue chapter 5. You have a assignment homework number 3 due the end of this week. Next week I posted the information for next week exam review sheet, formula sheet. So you need to start to prepare for the test. Go through the review sheet and formula sheet. Exam 1 include the 5 multiple choice question. Could be either concept question or calculations, and 3 problem solving questions. It covers the material from chapters 2, 3, 5, 3 chapters. The test will be held from 12 to 12:50. Okay, so our class time on Tuesday, not Monday, because Monday is holiday and the Tuesday follow Monday schedule. And you should take the test on my course. You need to log in our Zoom meeting, turn on the camera, and keep your computer on mute. I'm gonna practice them like in the classroom. You can have this test is the closed book, closed notes. You can use formula sheet, no cheating sheet. Okay, the test doesn't allow for back checking because my course does not function well on the option. So please don't go back. Okay, so go back, check. You please complete question by question. Any question? If you study well, you can finish the test like in half an hour. But if you didn't study well, you probably cannot finish by on time. So, but anyway, our test have to be finished before 12:50. I know some students have other class following. So you need to study well, and the test will be very easy. And the question will be randomized. So that means the test question, the order will be different from you and others, for you and others, okay? So it's not easy to cheating, okay? So you need to study well for your test. Question? For the review sheet, formula sheet, I think it's not easy to take the test in the computer and also watch and look the formula sheet in the computer as well. So my suggestion is either print the formula sheet or handwrite down all the formula on the paper. Okay, I think that's easy way to an efficient way to take the test and use the formula sheet. Okay, so today we're gonna study chapter 5. It's talk about future and forward pricing. Okay, how to price, how to get the calculate the forward future price. So first we're gonna talk about the difference between consumption and the investment assets, and then there are 3 cases for investment assets, which we're going to talk about the 2 of them. Okay, we don't have time to talk about 3 cases. We talk about 2 cases. In each case, we're going to talk about forward price, how to calculate forward price, and we're going to talk about arbitrage opportunity. So that's a very important issue in this chapter. And since we focus on the future contract and how to value the forward contract, which is very similar. Okay. So in this chapter, we're going to examine how forward price and future price are related to spot price of the underlying assets. So estimate the forward price based on spot price. Okay, that's our the way to do. Okay, we focus on the relationship between the forward price and the spot price because there is no daily settlement for forward contract. Consumption investment assets, underlying assets in the future forward contract can be any type of assets, but we can classify them into two categories. One is called investment assets. Investment assets is assets held solely, okay, highlight solely, for investment purpose by at least some traders. For example, stock, bonds, gold, silver, okay, for investment purpose. Stock, bonds, that's easy to understand. And for the gold and silver, can be used for consumption purpose, but here they hold just, the investor hold just for investment purpose, okay? Investment assets do not have to be held exclusively, for investment, such as silver, right? This is about investment assets. What about consumption assets? Consumption assets is assets that hold primarily, really, okay, primarily for consumption purpose. For example, copper, crude oil, corn, and pork bellies. Okay, here examples. We can use arbitrage argument to determine the future forward price of investment assets from a spot price, but we cannot do this for consumption assets. So we're going to focus on investment assets. Okay, let's see example 1. Which of the following is the consumption assets? A, S&P 500 index, B, Canadian dollar, C, copper, D, IBM stock.
Copper?
Yeah, copper, right? Because others is for sure not consumption, right? Dollar stock index. Okay, yes, answer is C. So next we're going to talk about, there are 3 cases for investment assets. In the case of investment assets, we have considered 3 different situations. First, assets provide no income. Second, assets provide a known dollar income. The third one, the assets provide a known yield income at the percentage, but we will not cover. Okay, so we just talk about the first 2. Assets provide no income. For example, stock will not pay dividend, and bond will not pay coupon. So that's called provide no income. So first we talk about case 1, when investor assets provide no income. This is the easiest contract. The easiest forward contract to value is one written on investment assets that provide the holder with no income and for which there are no storage costs. Example, non-dividend paying stock, 0 coupon bond, right? No income, no dividend, no coupon. That's called no income. So for each case, we're going to talk about talk about the forward price. The other talk about arbitrage. So for each case, we're going to talk about these 2 issues. First, when investment assets provide no income, the equation for forward price, okay, forward price, basically we have 2 timeline. On the timeline, we have 2. One is 0, which is today, and the other is called T, expiration day. So the forward price in time T today, the forward contract, the price, calculated based on the spot price, and do you see E exponential, and the power is called is RT. R is risk-free rate. T is the time until delivery day in years. For example, six months. For example, 6 months, then T equal what? 6/12, right? Because the unit is year. Okay, so TRT, that's the power. We do exponential, so this is the continuous compounding, right? This is basically it's continuously compounding. So that means the forward price is in equilibrium. In equilibrium, you need to pay today. The forward price is the price when spot price accumulate to T, time T, which is S0, ERT. So this is the amount, if the market is equilibrium, this is the amount for spot price accumulate to the time T. So this is the forward price. Okay, so forward price, how to find the forward price? Forward price is based on the spot price and accumulate to the time T. Okay, I hope you understand spot price and forward price, they are different, right? And what about the forward price in time T? Here T is the small t, which is between 0 and T. Could be any time. Okay, could be, for example, the expiration day is 1 year, and the small t could be 2 months, 3 months, 4 months, 6 months, 7 months, right? So could be any time between 0 and the capital T. So we want to find out a general formula for forward price in time T. So the price, how to get this forward price in time T, we're going to do, again, we based on the spot price at the time T. So the spot price at the time T normally given, okay, should be given. And again, same thing, we do consider equilibrium and the continuous compounding based on the spot price at the time T. So but here the important thing is the T. What is the power for T? We do the difference between capital T and the small t. Okay, so we only consider the timeline which is not happened yet. If it's already passed, it's passed. We not consider any timeline already passed. We only consider timeline from T, small t, until the expiration capital T. Okay, so that's why the capital is T minus T. Understand? I think this is a very important part for you to understand the forward price in time T. Question? So at the beginning, I said that we're going to talk about forward price. Also, actually, we should add one more is value. We talk about the value of the forward contract. Okay, so that's next. We're going to talk about the value of forward contracts. A forward contract in time 0 and T. We use small f to represent the value. Small f represent the value. So F0 means the value of the forward contract at the time 0 is always 0. Okay, so this is the fact, which is always 0. A forward contract in time 0 today is worth 0, except for bid offer ask spread effect when it first negotiated. But later it might be positive or negative. Positive means gain, negative means basically lose money, right? Suppose that K is delivery price. So how to find K? K, basically you should go back to here. K is F0 is K. Whatever you estimate the forward price at the time 0, and this is the delivery price. Okay, so as long as you find the the forward price at time 0, that's also the delivery price. And the F0 is the forward price for a contract that would be negotiated at the beginning, the life of the forward contract. Delivery price is set equal to forward price. You see? So K equal F0. So here talk about the value at the time 0. The value at the time 0 is 0. The material in this chapter is kind of complicated. I hope you read the book and watch the video, go through the slides, do the assignment. I think only after you did all this, you should be able to do any question, okay, in the test. Okay, next slides talk about the value at the time t, which is the any time between capital T and 0. What would be the FT, which is the value of the forward contract in time T? This value could be positive, could be negative. So how to get it? We consider the difference between the contract with delivery month K and the contract price FT. So basically, we have a delivery price at the time T, and also we have a FT. FT at the time capital T and the K. This is the value, which is the difference between the forward price and the strike price. We discount back this value to time T, which is do discount. You see here's negative. When we talk about the price, forward price, we do accumulation. And here we do a discounting, right? So you need to understand why. Okay, so rather than just memorize the formula, I think you need to understand why. Here we talk about long and short position because they are just opposites. So let's see the long position. Long position, the value FT calculated by the forward price at the time T minus strike price. Forward price at time T minus strike price. And you see, if T equals 0, F0 minus K is 0, right? Because K equal F0. So that's why the value of the forward contract at the time 0 is 0. Okay, so you do discount, continuous discounting. So exponential to the power negative. Negative means discounting. Okay, again, times risk-free rate times T minus T. Why? Because we only consider the time period which is not happened yet, right? So if this is the formula for the forward, the value of forward contract at the time T, and if you do some adjustment, you can get this actually another formula, which is the ST minus K, because FT times E exponential discounting value should equal ST. ST minus K times E times discounting K, which is the strike price discounting back to the small t. Okay. This is long position. If it's a short position, that's easy. Just add negative. Just add negative. Okay, just add negative before in front of the long forward contract for the value. Okay. So you can think about this is the two formula or one formula. Depend on the question the information given. If you are given the spot price at time T, you can use this formula, right? If you are given the forward price at the time T, or you estimate that already, then this is the easy way, right? So depend on the question given. We have example next. Let's take a look at example, see how we're gonna use this formula. Okay. Example 2, a 1 year A 1 year means what? T equal 1. Long forward contract. Okay, so this is take long position. A non-dividend paying stock, so no income. When stock price is 40, so S0 is 40. The risk-free rate is 10 or 0.1. With continuous compounding, okay, make sure you do continuous compounding. Question 1, what is the forward price and initial value of the forward contract? Okay, so question 1 basically asks you what's the F0 and the small f0, right? Small f0 is 0. We don't need to calculate. That's always true, right? For the forward contract, always true. So what would be the forward price? Remember the slides, we estimate forward price based on the spot price at time 0 and do continuous compounding RT, right? So S0 is 40, continuous compounding interest rate 10%, and the T is 1 year. So please calculate forward price. In the class, please do the calculation, and you practice more, you're going to be more confident, right, in the test. So please do the calculation. Anybody get the number?
$44.21, Professor.
Yeah. Yes, that's good. Yes, 44.21. Okay. Exponential, you should be able to find a function in the calculator. Okay, I hope you found it. 44.21. That's correct. Good. So question 1, what is the forward price? Forward price is 44.21. What is the initial value? 0. Okay. So question 1 basically talk about the time 0. And here is 1 year. Question 2. Okay, 6 months later. Okay, so the small t is 6 months. So t is what? 6 over 12, right? 6 over 12. 6 months later, the price of the stock is 45. So here is what? ST equal 45, right? And the risk-free rate is still 10%. What are the forward price? Okay, so first we calculate capital F. Capital F, we based on the spot price at time t, and we do compounding for how long? Which is 45. We do compounding interest rate 10%, and capital T is 1, and the small t is 6 months, so 6 over 12, right? So make sure the power, okay? Make sure the power, you can calculate the power. What is the how long is the remaining time period, okay? The remaining time period, which is the 6 months, because the total contract is 1 year contract and 6 months later, so only 6 months left, right? So tell me what's the forward price you calculate?
Is it 47 and 31 cents?
47. Yeah, that's correct. 47.31 cents, right? Yes, that's correct. This is FT. Okay, and question 2, what is the value? Okay, FT. Remember, we calculate FT, we calculate the value. You can based on the FT or ST, doesn't matter. It's up to you. You can based on the FT because already find FT. FT minus K. Okay, one more thing we forgot in the first question. We find the F0 is 44.21. This is what? K. Okay, so we can find K from delivery price from question 1. And once we calculate the difference, we do discount negative R T minus T. Again, the time period is only 6 months. So we do 47.31 minus K is 44.21. And then do discount 0.1 times 1 minus 6 over 12, right? So what is the value? What is the value?
Professor, is it $4.50?
No, can you double check?
Yeah.
Make sure this is negative, okay? Make sure negative.
Okay.
It's discount, yes, good. So you can see when we calculate the forward price, we do compounding. When we calculate the value, we do discounting. Anybody got the answer?
Is it 2.95?
That's correct. Good. 2.95. Yes. So we done this question. Okay, we done this question. So you have a question in your assignment similar to this. Any question from this example?
Professor,
Yes.
what's the
Yes.
difference between the forward price and then the value of the forward contract? What's the difference?
The value, the price basically the what are you gonna pay if you buy the contract, right? The price is the if you buy in the middle, how much money you should pay for the contract, okay? And
Okay.
the value basically is you gain or you lose, okay, compared to yeah. So which is the based on the price you pay and the price you're gonna the forward price and the delivery price, which is the price you gain and the money you receive and the money you pay. We talk about the difference.
Oh, okay. So it's just the gain on the contract.
Yeah, right.
Okay.
Yeah.
All right. Thank you.
No problem. Okay, let's see example 3. Example 3, similar to example 2, but here we talk about the short contract. Okay, the only difference. Again, let's see. The short forward contract negotiated some time ago. We don't know when they start, but we know expire in 3 months. So we don't know when they start, but we know it's only 3 months expire. Okay. Delivery price K is 40. The current forward price for 3 months forward contract is 42. Forward price. So FT is 42, right? 3 months risk-free interest is 8%. What is the value? Okay, ask you to calculate the value. FT, because this is short position, so put negative. Okay, put negative, and then the other would be the formula same as the long. So we're gonna do FT minus K and do discounting, T minus T. We don't know capital T, we don't know capital T, but we know T minus T, which is the remaining life is what? So here is the T minus T equal 3/12, right? Okay, so negative FT is 42 and the K is 40. Interest rate 8%. And the number period remaining is 3 months. So can you calculate the value of the short forward contract?
Is it negative $1.96?
That's correct. So negative means you lose money, right? If you buy this, if you take a short position on this contract, and the 3 months remaining, and you're gonna lose money. Okay. So the value of the forward contract could be positive, could be negative during the contract period. Okay, but at the beginning is 0. Okay, so we talk about the price, we talk about the value. Next, we're gonna talk about arbitrage opportunity. So arbitrage opportunity, why? Why did arbitrage opportunity? Let's see. We know F we know the forward price F0. We calculate the forward price at time 0 based on the spot price at time 0, right? So this is the equal. This means when market in equilibrium. Okay, which is no arbitrage. If this is not equal, then there is arbitrage. Okay, so if not equal, we have two cases, either greater or less, right? So we have two cases. If forward, we call this is the market forward price. And this one is, you can put like F hat. So this is called estimated forward price. So two forward price, we're going to compare them. One is from the market. Market forward price greater than the estimate forward price. Estimate forward price, we assume they are equal, right? So we equal, these two equal, so we can get estimate forward price. We compare these two price. If this is the case, market forward price, we're gonna buy low, sell high, always. Buy low, sell high to make money. Okay, so this is always true for any case. We're gonna buy low, sell high. So for the first case, the market forward price greater than, this is the first case. The forward price, the market forward price greater than the estimate forward price, so we're gonna buy low, sell high. So we're gonna buy what? We're gonna buy the right-hand side. The right-hand side is is low. So buy low, we're gonna buy a spot price, buy assets, spot price, which is buy assets. And then we're gonna do investment. Okay, so here is the strategy. Buy 1 unit of assets and buy, it says buy $0. So this is basically it. You borrow money to buy. You don't need to use your own money. You borrow money to buy. And the left-hand side is high. Market forward price is high. We're gonna short it. So you're gonna short a forward contract on the 1 unit of assets. So basically buy low, buy right-hand side, sell high, sell left-hand side. Okay, that's the strategy. And then at the time T, you're gonna sell the assets because you short a contract. So you sell the assets to get the F0. This is the delivery price. The amount of this is the amount you're gonna pay because you borrowed the loan, and the investor profit is difference between these two. So this is the profits. We're gonna see example how we're gonna do that. So this is just talk about arbitrage opportunity case 1. Let's see example 4. What is arbitrage opportunity when forward price is out of line with the spot price for assets providing no income? So in this case, we know the assets S0, 40, forward price. Okay, here forward price is market forward price. As long as it's given, it's market forward price. So which is a capital F, 43. And then we want to know what is estimated forward price, right? We want to compare them. So estimate forward price based on the formula, based on the spot price, and do continuous compounding, right? So we know the spot price 40 and the interest rate 5%. And the time period maturity is 3 months. So first estimate the forward price. Can you do estimate forward price? So first step, you're gonna, this is the first step. You're gonna estimate the forward price first, and then compare with the market forward price. What's the estimate forward price?
40.5.
40.5, yes. 40.50 cents. Compared to the market forward price, is smaller, right? So this is the relationship, which is market forward price higher. So we're gonna action our question. What is the arbitrage opportunity? Yes, and then how? So our action now, which is now, you're gonna do what? Buy low, buy assets. Buy assets for how much? You need to pay $40, right? And you're gonna make a loan. You're gonna borrow money. You don't need to use your own money. Borrow money. Borrow money. How much? Borrow $40, right? So that's your principal for 3 months. And then you're gonna sell high. Left hand side, you're gonna take a short position, short a forward contract. And the delivery price is what? For 43, right? That's the price, the forward price. And then action in 3 months. In 3 months, because you short the forward contract, so you're gonna sell assets, sell the assets for $43, right? You sell the assets for $3, and you need to repay the loan, right? You borrowed money, so you need to repay the loan, and the loan, because the principal is $40, and then you accumulate continuous compounding for RT, right? So this is basically it here, right? So it's $40.5, 50 cents. So the profit, which is the money you receive minus the money you pay. So money you receive 43, money you paid 40.5. So your profit is what?
$2.50, Professor?
Yeah, 2.5, right? 2.50, yes, that's correct. Okay, so 2.5 is basically your profit for one contract. If you buy more, then times the number of contracts, right? Okay, so this is the arbitrage case 1, when the market forward price greater than the estimate forward price. You're gonna do this action. So my expectation, you do this type of question is first, it's like this. First, figure out what's the estimate forward price, and then compare with the market forward price, so that I know you understand how you get the action. Okay, so the next step is the actions, now actions in 3 months. So this is my expectation you're gonna do. Okay. So in the slides with the solution, here is the solution. You need to provide the actions now. Action in 3 months, 1, 2, 3, 1, 2, 3. Okay. As long as you understand, I think it's very easy to figure it out. But if you do not understand, just to memorize is very hard. Okay, it's no way to memorize. Question? So we just talked about the one case when market forward price higher, right? What about lower? So the other case, if the market forward price lower, again, we're gonna buy low, sell high. Buy low, buy forward contract, right? In the market, and sell high, sell what? Short. We're gonna short, which is sell the assets, right? And when you sell the assets, you're gonna receive money, right? You're gonna invest the money, okay? And to receive interest later, right? So the actions, which is opposite to the case 1, the arbitrage opportunity 1, we're gonna sell the assets, invest the proceeds, and take long position. And the delivery price is F, market forward price. Okay, so at the time T, the cash invested this is the money you're gonna receive from the investment, right? The money you're gonna receive from investment. And also the assets is repurchased because you take long position, you need to buy the assets for F0, which is delivery price. Investor make a profit, which is the difference between the money you receive and the money you pay. So you need to really understand that, not memorize, okay? So always buy low, sell high. That's always true. You don't need to memorize. Just think about the which one high, which one low. You're gonna buy low, sell high. Okay, so let's see a multiple choice question. What should a trader do when the 1 year forward price of assets is too low? 1 year forward price is low. This is market forward price is low. What would be your action? You're gonna buy low, sell high, right? Think about buy low, sell high. So buy low, which is buy the contract, sell high is sell the assets, and what? Do investment, right? Which one? Answer A, B, C, D. Which one is the answer? Anybody can tell me which one is the answer?
Would it be A, Professor?
A?
Yes.
Can you try it one more time? Not A. A, they the short contract. We are not.
Oh, would it be B?
Is it D?
Yeah, D. Not B. B is borrow money. Borrow the price. No, we invest. So we short assets, invest the proceeds, and enter long forward contract. Yes, answer is D. Yes. Okay, so if the question asks you, if the price at the 1 year forward price of assets is too high, which one should be the answer? If I change low to high, so you can see the question can be very different. So as long as you understand, I think that's easy, right? So which one is the answer? If it's too high, if it's too high, so the market forward price is higher than the estimate forward price. So you're gonna buy low, sell high, right? Sell and buy. So borrow money to buy and short. Yeah, this is for if it's too high. Okay, yes. So this is for case. And this is for case. I hope you understand, okay? Not memorize. Question?
No questions, Professor.
Okay, let's do one more example. This example talk about the second case, which is the forward price is low. What is arbitrage opportunity when the forward price? You see the assets price is 40. Assets price is 40, so S0 is 40. And the forward price, which is market forward price, is 39. So market forward price is 39. And you need to estimate the forward price, which is based on the spot price, ERT, right? Interest rate 5% and the 3 months. So 40 times interest rate 5%, T 3 months. I think this is the same as the example 4, right? So for 40.5. 40.5 compared to the market forward price is 39, so this is greater, right? So since this is greater, so we're gonna buy low, sell high. Buy low, we're gonna long a forward contract, and sell high. We're gonna sell the assets and invest the proceeds, right? So action now is what? Sell assets. Sell the assets for how much? You're gonna receive $40, right? And then you're gonna invest $40 for 3 months to receive interest, right? And then you're gonna take a forward contract, and the forward price is what? $39, right? Which is the delivery price. Then action in 3 months. First, because you take a long forward contract, so you're gonna buy assets for how much? $39. And you invest, so you're gonna receive what? Investment income. And the income should be principal 40 and accumulate for 3 months, right? So which is 40.5. We find here, right? 40.5. And the profit, which is the difference between the money you receive, 40.5, and the money you pay, 39. How much is the profit? The profits.
The profit is 150, Professor.
Yes, 1.5, right? $1.5. This is the profits you're gonna receive from this case. So today, to summarize, today we talk about the case 1 when the underlying assets pay no income, and we talk about the forward price, the value of forward contract, and arbitrage opportunity for 2 cases, right? So next class we're gonna talk about case 2. Okay, which is the company pay dividend, pay dollar in known dollar income. Okay, so that's all for today. You can start to do the assignment. I think the question similar to what we discussed today. Okay, again, next Tuesday, we're gonna have the first test. The test question is all similar to what we discussed in class. As long as you study well, you can finish the assignment, finish the test in 30 minutes. But if you didn't study well, you probably cannot finish on time, okay? So this is like a test in the classroom. You need to study well, and this is the close notes, close book, okay, test. Any question?
Professor,
Yes.
is the time limit
Well-
specifically set for 30 minutes, or do we have the full 50 minutes to do it?
Half an hour. We don't have half an hour. We have a 50 minutes. The test material, which is number of questions I just give you, is for 50 minutes.
Okay.
Yes. As long as you signed up in the school with the Access and Success office, they ask for longer time. So if you have that contract, you can let me know, okay?
Thank you very much.
Yeah, sure.
Have a
So
great day.
you too. Yeah. Bye. See you Wednesday. Bye.